Let's see the question number 2. Accounting of depreciation. Asset purchased for rupees 1 lakh, 50,000 and 2 lakhs on 1110, 1111 and 1112. Three assets purchased in three different periods. So for example, this will be assumed to be the calendar year ends on 31st March, 31st December every year. That's how we can assume. For the year 2010, there is purchase of an asset rupees 1 lakh. That too on 1st January 2010. 1st January 2010. Another asset purchased in the next year, not the same year. So in 2011, they purchased another asset on 11011 for rupees 50,000. Another asset for rupees 2 lakhs purchased on 1112. So 2012. 1112 they have purchased another asset for 2 lakhs. So they have purchased three assets. In simple model, only one asset will be there. You can pass journal entry for the one asset, but when we have the complicated illustrations, we have 2 or 3 illustrations. 3 assets purchased together. Meanwhile, some of the assets might have been sold in the halfway through. So what you do for one asset model is going to be repeated for all the assets. That's all. The rest of the things are the same. On 1/10/2011, the asset purchased on 1/1/2010 was sold for rupees 70. On this date, there is a sale. Which asset? The asset purchased on this date. Sold. Sold for at what rate? 70,000 rupees. Sold for 70,000. The rate of depreciation of the above asset is 10%. And straight line method is going to be followed. So the rate of depreciation. I usually give the notation for the rate of depreciation as small d. Capital D represents the amount of depreciation, right? So you should keep that in your mind. So small d represents the rate of depreciation at the rate of 10%. And then the method of depreciation here being SLM, straight line method of depreciation or original value depreciation method. Prepare asset account under different methods of accounting for treatment of depreciation. Treatment of depreciation. So we can charge the depreciation or subtract the depreciation amount from the asset account. This is the one method, or another method. We are going to accumulate that in the provision for depreciation method. So in the provision for depreciation account, in both the way you can follow. Let me solve this illustration in the basic model. Charging the depreciation in the P&L account and then deducting it from the assets account. That way. For the year 2010, we have one asset, and by the year end, by default, you have to provide the depreciation. After providing the depreciation, whatever the depreciation charge the year will be transferred to the P&L account. In year 2011, repeat the same in the year end. It should be by default, not required to be mentioned anywhere. So depreciation and amount transferable to the P&L account. In the last year also, for the year end, 31st December 2012, again provide the depreciation for the assets available. In the very first year, we have only one asset. So for the 1 year assets, we could provide the depreciation. In the second year, we have purchased new assets, so that will be eligible for the depreciation. Old asset was sold. As the old asset was sold, up to the date of sale, we have to provide the depreciations for this. Thereafter, it will not be eligible for the depreciation. And in 2012, we already have one asset, 50,000 purchased in 2011. Another asset purchased in 2012 is also there. So you have to claim the depreciation for the both years. So depreciation and profit and loss account. So these are the provisions these are the points you have to keep in your mind. See, first of all, when the depreciation related illustrations are there, try to understand in what are the days we are going to pass the journal entries. By default, at the time of purchases, at the time of sale. And year end, by default, you have to provide the depreciation and charge the depreciation to the P&L account and subtract from the assets. So these are the basic idea. For how many years? You just have this as a working note. This working note is a timeline. You will not forget about. So how many entries you are going to pass in 2010 for the purchase one asset, one entry, and another one is for passing the depreciation and transferring the depreciation to the P&L account. 3 entries are there in the first year. Second year, there is one purchases. For that one entry. On the same date, there is a sale. Whenever there is a sale of the asset, you have to pass the entry for the sale and depreciation of that asset sold up to the date of sale should also be now passed here. And year end, of course, we have to again provide the depreciation and transfer the depreciation to the P&L account for the asset left over available with the company, okay, with the firm. Is that okay? Now let's start with 2010. In 2010, this day 1120 purchase happens, 1120 2010, isn't it? 2010, not 2020, 2010. Okay. The journal entry for purchasing the asset being asset account debit to bank. Don't get confused with the terms I use here. Either it may be bank or cash. Interchangeably it can be used. So the value being 1 lakh in the debit side as well as 1 lakh in the credit side. 1 lakh in the debit and 1 lakh in the credit. And now I have to go for the year end for providing the depreciation as well as profit and loss account and transferring the depreciation to the profit and loss account. And the year gets over on 31st of December. That's how I assume. So for the year end, let's come here. On 31 December 2010. For the depreciation, the journal entry being depreciation account debit to asset account. Because in the very basic model, the depreciation is going to be deductible from the asset account. The value being 10% on the original value 1 lakh. For that 1 lakh 10%, 10,000 rupees. Is that okay? 31/12/2010. And then on the same date, when it comes for the year end, whatever the nominal accounts may be, that nominal account should be transferable to the P&L account. Salary, rent, interest, purchases, sales, whatever it may be, it should be transferable to the income statement, either trading and P&L account. So as the year end comes in your mind, it should be in your mind, right? What's that? Any nominal account should be transferable to the P&L account. Between these two, among the 4 items, which is the nominal account? Depreciation is the only item available as a nominal account, should be transferred to the P&L account. So the entry being profit and loss account debit to depreciation. Profit and loss account debit to depreciation. This value being 10,000. So successfully we have completed the year 1. Repeat the same step for the year 2. So you can now forget the year 1. Very simple. Okay. Now let me move on to the next year. In 2011. In 2011, asset is purchased on this date. 1/10/11. Asset is purchased. For the purchase, the entry being the usual entry, asset account debit to bank. Asset account debit to bank. The value here being 50,000, 50,000. Debit side 50, credit side also 50. Okay. This is over. This is over. And on the same date, the sale is also happening. So when the sale happens, you have to keep the thing in your mind is depreciation should be provided up to the date of sale for that asset. Number 1. Number 2, compare the book value with the sale value and find out if there is any profit or loss. Book value is nothing but depreciated value. From the original value, you have to subtract the depreciation as on the date of sale. And what is the leftover value? That will be the book value. Written down value or book value are the same. Now compare with the amount realized. Okay, amount realized. Then it may be either your profit or loss. That's how you can pass the entry. So I'm going to pass the entry for the sale. Now, for the sold asset, I have to provide the depreciation as on the date of sale. Depreciation account debit to asset. Asset. What's the value? 1 lakh is the original value. For that, I'm going to provide the depreciation under straight line method of depreciation, 10%. And in this year, I sold it on 1st October. 1st October means the asset could have been used from 1st January to 1st October as we follow the calendar year. So 1st January to 1st October, we have 9 months. So it's eligible for 9 months interest. So into 9/12. Into 9/12. So the 9/12, if I apply the depreciation as in the date of sale being 7,500. Am I right? This will be 7,500. Clear? So we have now passed the entry for the depreciation. What is the value of assets? 1 lakh is the value of original asset. For the asset, very first year we provided depreciation of rupees 10,000. Subtract that. So by the first year end, the value of the asset being 90. In the second year, where we have not used completely, we have used it for 9 months. Up to the 9 months, we can provide the depreciation, which is 7,500. If I subtract the 9,500 from there, today's value being 82.5. Am I right? That 82,500 rupees worth asset sold for how much? 70. As we are not able to realize the amount at which it is recorded in the book, then we can find out that as either profit or loss. But here the realizable amount is less than the amount appearing in the balance sheet. The amount appearing in the balance sheet for the asset as the date of sale is 82,500, but sold it for 70. Then difference between these two, 12,500 rupees is the loss charged to the P&L account, or you can consider that being profit or loss on sale of asset. But if I keep that as a loss on sale of the asset, the year end, that loss of sale of the asset should be transferred to the P&L account. Let me go for the second option. I am going to charge that to the loss on sale of asset account, right? So asset account and the same date, bank, I am getting the money, right? So bank account debit. How much will I get? Only 70,000 rupees. Only 70,000 rupees. To what? Asset account. What is the value of the asset? As per the books or WDV, 82,500 we have calculated here. So I charge that value here, 82,500. And 82,500 rupees worth asset sold for 70, it means I lose 12,500. The amount what I lose here is nothing but what? Loss on sale. You can name this being loss on sale of assets or simply P&L account. If I name this as being the loss on sale, by the year end, that amount should be transferable to the P&L account. For any year, if you pass n number of entries for the year end, out of those entries, find out any nominal account, that nominal account should be closed by transferring to the P&L account. Right, so I keep that point in your mind. So I'll finish up on year end. Let's go for the year end to provide the depreciation. The depreciation for the year end being 31st December 2011. Depreciation account debit to asset account. How much is that? Old asset. This asset was sold, so no more this asset is eligible for depreciation. Only the new asset purchased on 1/10/11 will be eligible for depreciation. That too, it is not purchased in the year beginning, purchased only the halfway through. So it is eligible for depreciation only for the period of usage. The usage of the asset starts from 1st October. From the 1st October, you just go up to the year end. So from 1st October to 31st March, we have only 3 months, right? So you have to calculate depreciation for the 3 months. Now 50,000 into 10% into 3 by 12, what is the value? Yes, 1,250. Am I right? 1,250. Okay, 1,250. Then year end comes automatically. All the nominal accounts should be transferable to the P&L account. For the 2011, what are the nominal accounts we have? Depreciation, one account where we have 2 depreciations, and loss on sale is also another nominal account. These 2 nominal accounts are going to be now transferred to the P&L account. Transfer entry is very simple. Currently, that account is showing debit or credit. Just think about that first of all. If that account shows debit, to be now cancelled, right? Transfer means you are going to remove from there. To remove a debit item, it should be credited, and where it goes, there it should be now debited. That's the logic. Here, the depreciation being the debit side, to remove that item, I have to now credit that. So to depreciation. This value being how much? Here is 7,500, here is 1,250. You can club and post. You don't transfer the depreciation individually. What we usually do? Pass a journal entry, prepare the ledger. In ledger, we are grouping all the nominal accounts, right? Only the grouped total value will be transferable to the trial balance. From there, the summed up or aggregate value is going to be transferred to the P&L account. So you no need to individually transfer the depreciation to the P&L account. Collectively, 7,500 and 1,250 both put together, it comes under around 8,750 should be now transferable to the P&L account. and this loss should also be transferred to the P&L account. Okay, this is debit balance. To cancel this, to loss on sale, to loss on sale. The loss on sale value being 12,500. You can either pass a separate entry for depreciation and separate entry for loss on sale, or you can combine that. On combining that, the final entry being profit and loss account debit to depreciation to loss on sale. Both put together, the total value being 21,250. Am I right? Verify that. So finally, this value can be transferable to the P&L account. Right. Now we'll be in the last year, 2012. In 2012. In 2012, what happens? We purchase one more asset on 1112. In the year beginning itself, we purchase one new asset. Okay. For the purchase, the asset entry being, purchase entry being asset account debit to bank. The value of asset purchased here being 2 lakhs. So 2 lakhs debit and 2 lakhs in credit. Is that okay? The next entry will be calculating the depreciation the year end. So straight away we will go to the year end, 31st December 2012. Depreciation account debit to asset account. How much is that? So we have two assets used full year. The first asset 50,000 is also there, used in this year also, not only used in the previous year. In 2011 we purchased this asset in October. So we depreciated 3 months amount there. In this current year, this 50,000 rupees worth asset is used fully. Not only that one asset, we have another purchased another asset 2 lakhs. This asset is also eligible for full year's depreciation. So 2 lakhs plus 50, 2.5 lakhs is the full value for that. You have to find out the depreciation for the full year at the rate of 10%. So 10% on 2.5 lakhs be 25,000. 25,000. Is that clear? Depreciation account debit to asset account. So as we reach the year end, whatever the nominal account we have should be transferable to the P&L account. For that, the entry being profit and loss account debit to depreciation. That's all. 25,000. So we have passed that entry here. So what is the requirement? Prepare asset account under different methods. Now we have passed the journal entry. Now we have to prepare the asset account. So in this case, the ledger is only for the asset account. Sometimes you may be asked to prepare the ledger account for the depreciation as well as an extract of the P&L account. Let me explain those things also for your better understanding. As it's a concept illustration, try to understand the full view. Okay, then you can solve few illustrations in addition to this, having the same pattern. You become master with that. Is that clear? Let's now go for the preparation of assets account. Okay, this is no more required, so I will just erase. Right. Now, asset account. Right. Start from here. First entry being, I skip the dates. Okay, you can solve the illustration with the dates. I skip the date. Asset account to bank, and to buy also being skipped here. Okay, 10,000 rupees. 1 lakh rupees. And then here is asset is going to be debited for the same year. Depreciation. This value being 10,000. This value being 10,000. If you tally, then first year is over. Then you have to close it off the same date. No, I am passing the asset account. I am posting only the asset. This is the asset account posted. This is the asset account we have posted. Okay. On tallying this, for the first year I had to close it off. On closing, come on, get me. You will be getting the closing balance. 90,000 rupees. Balance carried on. Balance carried on. Here it is being balance brought down. Balance brought down 90,000. We'll go for the next year. In the next year, asset account debit to bank. So I'll simply put that value in the debit side, bank. one more asset purchased, value being 50. On the same date, one of the oldest assets purchased in 2010 is sold. And before sale, we have to provide the depreciation of the asset sold up to the date of sale. So depreciation. Depreciation being 7,500. And here is asset. 80 to 500 rupees should be in the credit side. It means by bank and by loss on sale should be now posted here. Okay, by bank, by loss on sale. Profit or loss, simply profit or loss. Loss on sale. The amount collected of selling that particular asset is 70. As we realize the amount less than the book value, the difference between these two is loss, also now charged the profit or loss account as loss on sale, 12,500. And the year end, again, for the another newly purchased asset, for that the depreciation is eligible. So by depreciation, the value being 1,250. Depreciation 1,250. Second year is over. Now you tally this. If I tally this, yeah, 1,40,000 rupees, 1,40,000, 1,40,000. You will be getting the balance carried down for that year. 48,750. Suddenly the thing should come in your mind is, we have only newly purchased asset 50. For the newly purchased assets today we have provided depreciation only 1,050. Then only one asset left over. After that asset's depreciation should be how much? 50 minus 1,050, 48,750. Cross verify should get tally. So you can always cross verify rather than depending upon the calculator or depending on the calculator. Finish off as quick as possible. Then you can verify with the calculations. And if there is any error, you can double check and cancel it. So this is what about the method of double checking. This balance carried on becomes the balance brought on the next year. So balance brought on here. The balance brought on here being 48,750. In the last year now, we don't have any other new sales, but we have only purchases and depreciation here. Asset account debit to bank. So to bank, the value being 2 lakhs. The value being 2 lakhs. And for the year end, we have depreciated that asset. So by depreciation, the amount of depreciation for that year being 25,000. Now finish off tallying this, you will be getting the balance carried out. Final balance here being 2,23,750. Am I right? 2,23,750. 2,48,750 being the total of both the sides. And balance carried on becomes balance brought down for the next year being 2,23,750. Okay. As already told you, sometimes you may be asked to prepare the other account like the depreciation account and profit and loss extract. Year on year, the depreciation is a nominal account. No, will have no balances. What are the accounts will have the balances to be carried over the next year? Real account and nominal account. If the accounts being nominal account, real account and personal account, real account and personal account will have the balances. What are the accounts will be appearing in the balance sheet? Only the real account and personal account. Nominal account will not appear there. Is that clear? So whenever we get the nominal account in the year, that account will be closed by transferring to the P&L account. Okay, what are the nominal accounts we have in these journal entries? Depreciation and loss on sale should be transferred to the P&L account. Let's now open the depreciation of asset depreciation account. Depreciation account for the year 1. I pass only for the first year. Okay, here is depreciation to asset. Okay. This value being 10. And the next entry for the same year being the depreciation is charged to the P&L account. Then it may be by P&L account 10,000 rupees. 10,000 rupees. Is that okay? Automatically this account gets closed. You don't have any balance carried on or brought on. Clear? See, in the case of assets, the real account will definitely have the balance if the asset exists. So that may be balance carried on and it may be rewritten as the balance brought down, which is the starting point for the next year. When it comes to the nominal account, it will be automatically closed. It will be closed. Whatever the balance we have in the nominal account is transferred to the P&L account. It will not show any balance thereafter. And suppose you may be asked to prepare the P&L account. You cannot prepare the P&L account Always remember, if you are asked to prepare the P&L account in this scenario, means depreciation chapter, it's not real P&L account, it's only an extract of the P&L account. Okay, extract of P&L account is nothing but some items could have been transferred to the P&L account from the journal entries we have past is recorded there. Don't tally it, leave it as it is. Don't tally it, leave it as it is. Is that okay? In the very first year, P&L account debit to depreciation. Usually what you do, if you are aware about the final accounts, right? In final accounts, depreciation is usually debited to the P&L account. Am I right? So where and how this will appear is nothing but this one, 10,000. Now, my question is, will the P&L account show only this depreciation, the P&L account debit set, or any other accounts also will be appearing there? Definitely, right? Not only depreciation, it will show other accounts also like salary, advertisement, stationery, etc. And we usually start with the GP transferred from the trading account to this P&L account. I skip that for the time being because I'm not aware about that. And I'm not aware about the other accounts to be now debited or credited the P&L account. So that's why it is not complete P&L account. It's only a summary like. That's why it is named as profit and loss account extract. Is that okay? Now this will be passed, this type of account should be passed year after year. For the second year, you repeat the same. Third year, you repeat the same. So most probably in your examination, the depreciation account and P&L account extract may be rarely asked. So the main load will be in preparation of the assets and journal entry only. Suppose sometimes if you are asked to prepare the depreciation account and loss of sale of asset account, then you need to know how to pass that. And when it comes to the P&L account, you have to have the logic. It's only an extract, not the complete one. Is that clear? Come on, make a note of it.